We are proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. Hi, I'm your host, Bob Powell. I serve as the editor of the Retirement Management Journal, which is published by the Investments and Wealth Institute, and I also serve as the editor of Retirement Daily, which is published by The Street. My guest today is David John, a non-resident senior fellow in economic studies at the Brookings Institution and a senior strategic policy advisor at the AARP Public Policy Institute. So welcome to the podcast, David. Thanks for being on it.
Oh, thanks for having me.
It's a pleasure. So before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief summary?
Sure. I wear two hats. My main job is with AARP's Public Policy Institute, which is the internal think tank. And I focus on savings policy in general and retirement savings policy in specific. I am also the deputy director of the Retirement Security Project at the Brookings Institution, a think tank in Washington. And in this case, we focus on improving retirement outcomes for people with incomes of between roughly 20 and 80,000. Our work initially focused on automatic enrollment and increasing the use of that. And in more recent years, we've looked at a wide variety of things, including how to convert retirement savings into income easily, and a wide variety of other areas.
Right. So we'll be talking more about one of the papers that you co-wrote there as part of this podcast. But the first thing and the more timely thing is the 2019 Secure Act was signed into law in December, and many folks, many investment advisors, financial planners are still trying to grapple with some of the changes. Obviously, we recently had a podcast with Jeffrey Levine talking about the IRA rules. But we never talked about in that podcast, and I think this is appropriate for you to talk about, are some of the 401k provisions that were changed as a result of the Secure Act. Do you want to sort of walk us through what you think investment advisors need to know about that?
Well, there are a variety of things. Probably the two most significant, and these are ones that have gotten a fair amount of coverage in the press, is first off, the creation of a safe harbor to make it easier for plans to include some sort of a retirement income solution into the plan. As your viewers or listeners are far too aware, in too many cases, people are handed their retirement savings and told go out and use them appropriately. And what this will do is enable plan sponsors to build in some sort of a default retirement income solution, whether it's an annuity or a phased withdrawal plan or something along that line. And it eliminates some of the regulatory barriers that kept a large number of employers from taking advantage of these types of products. Now, we anticipate, based on a series of polls and other discussions, that this isn't going to be something that happens overnight. When we look at discussions with employers, we find that most of them are actually sitting back and waiting to see what happens. But this act does remove a lot of unnecessary regulation and will make it much easier to convince plan sponsors to include these products going forward.
Well, just a quick question.
Sure.
I mean, at the moment, plans are allowed to include QLACs, for instance, are they not?
Yes. but they don't. And
And
that's the problem.
and they don't. Right. So there was some safe harbors around selecting QLACs. Does this sort of expand the safe harbor that allows someone to include not just QLACs, but maybe other kinds of deferred income annuities?
Yes, well, they could actually include things like building a SPIA into the offerings, or even potentially changing the target date fund so that a proportion of the money would gradually annuitize starting at, say, age 45 or 50. Obviously, we're going to have to wait for the implementing regulations to come out, but this looks like it could be very promising in the long run, as long as people are patient.
So there seems to be two challenges when I think about this provision, this part of the law going into effect. One is the uptake on the part of plan sponsors, and then the kind of education that might be required to help plan participants decide whether this is a good thing for them or not.
Yes, I think the education is going to be a key factor here, because when we've talked to employers over the years, they have gotten the impression that any talk of a retirement income solution is dangerous and opens them up to all kinds of litigation. So overcoming that initial type of bias so that they're even willing to listen is going to take a certain amount of effort and time.
It seems so strange in a day and age where people where those concerns didn't exist around defined benefit plans, and certainly don't exist around Social Security, that they would exist around this because for whatever reason, it seems so different.
It does, very different, but it is a fact of life, and I'm afraid this is something that we're going to have to overcome.
Right, right.
The second one, which is probably of less interest to some advisors, is going to be the creation of MEPs, the multiple employer plans, which are essentially like a group life insurance, except that in this case, the group is a series of unaffiliated employers who can sign on to what's essentially the same plan document and offer a simplified type of a 401k plan to their employees, hopefully at lower cost and much lower regulatory burden. The question that applies with this is going to be helping the employers to recognize that they still have a fiduciary responsibility to choose a responsible sponsor for this MEP plan. And once they have done that, of course, they have the responsibility to continue to monitor that they've made an appropriate decision. But this actually does open up an entirely new opportunity, especially for smaller business employees and employers, to get involved with a much better type of retirement income or retirement savings provision than they have currently.
And do you see what sort of role can investment advisors play in getting that adopted among small or medium-sized employers that don't have plans that have been reluctant?
Yeah, to the extent that the advisors have a relationship, whether it's on a personal basis or on a company basis with small businesses, this is an opportunity to inform them of this new type of plan and to actually push it as an option that they could develop.
And what's your thought about the challenges that it faces in terms of getting widely adopted?
Well, I think this is going to be an interesting question. Unfortunately, I think some of the providers have oversold themselves and suggest that this is going to be the new millennium and that there's going to be a huge demand for this. I think that what we're going to see is that employers who are already considering offering a plan and hadn't for some reason or another are likely to find this very attractive. And this is especially true of employers who are interested in attracting and keeping for the long run qualified employees. On the other hand, I think that it's not going to do a whole lot for a significant chunk of the other employers who don't offer a plan currently. And these are going to be ones whose business model may rely on high levels of turnover to keep compensation costs low or things along that line. So I think there will be a certain demand, probably especially among the professional small businesses, the law firms, the architects, the various and sundry other highly qualified individuals.
So in terms of the solution that it was trying to fix, which I suppose would be the coverage issue, and you are probably better to speak about these numbers, but I've seen numbers ranging as high as 50% of working Americans don't have access to a employer-sponsored plan at work. The attempt to solve that issue may not be this. This may not solve it. Is that fair to say?
Probably not. As I say, I think that what's going to happen is that there will be an immediate interest among certain employers, and other employers are not going to look at this, and we're going to have to continue to seek out other types of solutions to really finish covering everyone with a retirement income savings plan.
So a couple of the minor provisions in the Secure Act had to do with tax credits for small businesses that establish a 401k or SEP IRA or Simple IRA, as well as tax credits for adopting auto enrollment of participants. Any thoughts about the use and value of those two provisions?
Oh, I think that they're incredibly valuable and incredibly useful. I think that they are mainly going to apply to companies that were interested in offering this type of a benefit anyway. I think this may be the additional push to close the deal and get them to sign up for plans. I'm not sure that the amount of the tax preference is going to be necessarily enough to push certain other employers into offering a plan. But this is something that had been needed to be updated for a long period of time. So I'm absolutely delighted that they managed to include these.
Right. And let's see what else. There was a long-term part-time employees who work at least 500 hours in at least 3 consecutive years will be eligible to participate in their employer's 401k plan if it's offered there. Any thoughts about the impact of that? Is that a sizable?
Yeah, that's actually, there are a significant number of people that this affects. And I think that this is another one of those provisions that's going to gradually change, but very definitely a needed move. And like so many other parts of the Secure Act, this is one of the tiny provisions comparatively to the major challenges that could really make a difference in the long run. But again, what the Secure Act basically did was to sweep up a variety of relatively small essential changes into one package. And that doesn't mean that we stop now. One of the things that worries me is that having been involved with Congress for far too many years, they have this tendency to deal with an issue, dust off their hands and say, well, gosh, that's all we need to do on that subject, and we can turn on to some other subject at that point. And I think that would be a huge mistake. There is still a tremendous amount of work to be done on coverage, on participation, on leakage, on converting retirement savings into income. And it would be a huge mistake for Congress to decide, well, we've dealt with this issue and we don't have to look at it again for another 10 years or so.
I mean, it's kind of interesting when I think about the last time we've had legislation of this magnitude was what the Pension Protection Act of 2006, was it?
Yeah, 2006. So it's been almost 14 years. Now, there have been little tiny bits and pieces in the interim. And if you even compare, however, the Secure Act and its potential impact to the Pension Protection Act of 2006, the 2006 was a monument, and this is sort of a much smaller, less uh, extensive type of reform. We still have a tremendous amount of work to do.
So, are there other topics, provisions about the Secure Act with respect to employer-sponsored plans that we should discuss before we move on to the things that that you just sort of addressed in terms of what else needs to be done?
I think those are the key ones. I mean, again, this is one of those things that has the act has a tremendous number of sections. It was literally sweeping a bunch of leftover provisions from the past into one package. So it's worthwhile looking at the entire package and looking at a good summary that a wide variety of groups are providing at this point. But for the most part, we've covered, I think, the essential ones.
Yeah, and I think for the investment advisors and financial planners who might be listening, I think the chief takeaway is that there are things in there that they can be implementing with their existing client base, as well as maybe their prospects as well. This presents a good opportunity for them to sort of bring this up and add value to the
I think
relationship.
that's absolutely correct. Yes.
Right. Okay. So one of the things that you mentioned was converting retirement account balances into income. And in July, you and your co-authors at the Brookings at the Retirement Security Project authored a really wonderful paper that I think lots of people should read. Most of our listeners, if not all of our listeners, should read. So I think what would be best is if you could sort of hand walk us through the paper, which is called From Saving to Spending.
Yeah, so this was an interesting one. We were looking at the question of how do you create an automatic solution somewhat similar to automatic enrollment that enables people to convert their retirement savings into an income stream. What we're finding is that, contrary to earlier beliefs, where we figured that most people were going to spend too quickly, we also see that far too many people look at their retirement savings pots and they say, "Oh my God, this is all we've got. Some crisis is going to pop up in the next few years, so we better not touch any of it." I mean, as individuals, we are trained throughout our lives to preserve savings and spend income. And making that transition is difficult. So we looked at a variety of solutions initially, and obviously the first one that came to mind was a SPIA, the traditional single pay uh, income annuity. And the more we looked at that, the more that was problematic for everyday individuals. We know that in certain cases, in many cases, this product would be preferable, but there are a lot of individual circumstances, some of which are mentioned in the paper, where that doesn't apply. So instead, what we wanted was something that people could understand, that would be cost effective, and would be flexible enough so that although they would be defaulted into this type of a solution, if that did not meet their needs, they could very easily opt out of it and move into a different solution, perhaps including annuities, perhaps including a variety of other mechanisms. So it really has three parts. Part one is a phased withdrawal plan, which is different from the target date fund in that it's still an investment-based solution that provides a more or less fixed but not guaranteed income stream. And the investment pool in this case is also includes a wide variety of downside protection. So the idea is that you get a certain amount of growth from market increases, but at the same time, when the market dives, as it did say in 2008 or so, there would be the countercyclical investments that would protect you from the full effects of that. This would provide an immediate retirement income and get people used to the idea that this is what they've been saving for. We also include a separate emergency fund that would be roughly 10% of the retirement savings that would be available for unforeseen circumstances, whether that's healthcare, car repair, home repair, whatever. And last but not least, to deal with tail risk, a deferred income annuity that would kick in at roughly ages 80 to 85 and protect people from outliving their money. We also believe that this helps because it gives a definite endpoint to the management, the active management of their money, and enables a better planning and better usage that way. We feel that this three-part solution actually will work for the vast majority of people. And of course, the beauty of it is that since the money initially, or most of the money initially goes into this phased withdrawal fund, if the individual wants a different type of approach, they can essentially pull that money out without incurring the kind of loss that they would have if they had invested in an annuity right off the bat and then decided that didn't meet their needs. So those are the basic provisions of what we're proposing in this.
So this sounds like an incredibly easy solution. Two things, well, a lot more than two things, but just to start, there do exist managed payout funds at the moment, and I'm not sure what the take up is on these, but how are the existing products working in that regard, where people wouldn't be, I guess, are choosing it of their own volition to use this as a income option?
They do exist, and they exist with a variety of providers, and we're seeing a few new ones start to come out from certain providers. For the most part, these funds had the misfortune to be started right around 2008 or so, and the take up comparatively has been absolutely minuscule. Now, these are retail funds, and one of the things that we're looking at is the opportunity to have much larger funds that could both be sold by advisors and include, say, automatically enrolled people from hopefully a large number of employers to keep costs down and things along that line. But the existing funds are out there. We're seeing some interesting looks at internationally. So, for instance, certain multinational companies in Europe are developing this type of solution. And there is a very active discussion in Australia right now about creating this. So while the US market is very tiny, we think that going forward, this is going to be something that will be very attractive.
So, in terms of, I guess, making this happen in the U.S., would it require changes to the law, or do you see it that we could do it within the existing laws to create this
Now,
kind of?
that's actually an interesting question. In developing this paper, we talked to three very prominent ERISA attorneys. One of them told us, oh, well, this is something you can do right now. And there might be a few things that need to be clarified, but for the most part, this is something that could happen tomorrow. One of us told us that this was absolutely impossible, that this would require major changes in the law. And the third one came down in the middle. So
It's what I love about retirement. There's always a clear answer. Yeah.
exactly. So some of our friends like it, some of our friends don't like it, and we stand with our friends. So
Yeah, of course. I mean, so in terms of how this would work in practical terms, would the you'd say this would be a default option? Would it be offered to the employee 3 to 5 years prior to retirement, or at when they depart their company, or how do you sort of see working? And
I see for the most part that in order to be successful, this needs to be we need to start to talk about this 3 to 5 years in advance so that people have an idea of what's coming. They're comfortable with it. They can use the time to explore other options and ensure that this actually meets their needs, etc. The actual default into it really doesn't need to come until retirement. And at that point, then the transaction would happen, the automatic movement of their funds into this type of a program. And of course, they have the ability at any point in the interim or any point after the immediate move to say, no, I want to do something else instead.
And my sense is, you said at the outset that the Brookings focuses on Americans with income of 20 to 80,000. So this, I'm taking, I assume that this is an audience for whom they're a non-advice assisted audience, largely that this would be a do-it-yourself audience, so to speak.
Yeah, obviously, it's better if everyone has access to advice. But the reality is, even at higher income levels, this is not necessarily the case. Whether people are reluctant to seek out an advisor, whether they balk at the idea of paying for advice, for whatever reason, this solution we think would apply. Now, of course, it would be even better if it's done in conjunction with consultation with a good advisor who can help make sure that the retiree's individual circumstances fit this type of solution. And of course, a key factor is that while the Brookings Project focus is 20 to 80, realistically, we expect that this would be equally valuable for people with substantially higher incomes also.
So when I think about retirement income, I think also too about the complexity of someone's financial circumstances. They might have retirement accounts, they might have taxable accounts, they might have Roth accounts, and the need to create, we'll call it tax efficient income in retirement is especially critical for those who might have limited resources. Do you envision this working in a tax advantage environment in some form or fashion, or would that require some software or the assistance of an advisor?
Well, actually, we do anticipate that there would be a tax advantage product here. We think that one of the things which I did not mention, which I think is going to be essential, is the ability to roll into one fund, this one phased withdrawal fund, the money that has been collected in a variety of different accounts. One of the things that we did when we talked to providers was to address the question of, well, what happens if you have X number of accounts and a third of those are Roth accounts and the rest of them are traditional accounts? How do you handle that? And we came to the conclusion that it would be possible to roll all of those accounts into one phased withdrawal fund with just an artificial division between the two that would help people to calculate what their tax liability is at the end of the year.
Interesting. So the other thing, I mean, I look at this and it seems it's brilliant on paper, right? I think it covers a person's desire to have a standard of living in retirement. It has it manages longevity risk and it manages the need for retaining some risk in terms of emergencies and whatnot. So I can't imagine that there would be much resistance to offering this in some form or fashion, given that it meets so many needs.
Yeah, again, one of the things that we did was to talk to advisors and talk to others. And at least in theory, this seems to be an appropriate and interesting solution. Now, one of the things that all researchers resent is that real life fails to follow theory in all circumstances.
Yes, that is troubling, isn't it?
Yeah, it's the nerve.
So let me just go just have you touch on the QLAC for a second, which is in the paper, it mentions that the distribution option could be joint and survivor for the retiree and the spouse, or another beneficiary, or a single life annuity. And it strikes me that people's aversion to annuities is that they think that that they'll lose the money. And but in the case of offering someone a joint survivor, at least you've hopefully addressed the possibility that the money won't go to waste. That someone will benefit it. If not you, your surviving spouse.
Absolutely. And this is an essential part of actually the overall discussion about retirement income, aside from just our paper, is to explain to individuals the value and the traditional fear that I'm going to sign this piece of paper that takes my $100,000 and turns it into $560 a month or something less. And then I'm going to step off a curve and a bus is going to hit me, and there goes that money, and no one will ever see it again except the insurance company. So a joint and survivor is actually obviously required by law in many distributions. And this is something that is essential and really needs to be looked at. One of the side issues that we are seeing, and this is moving in a slightly different direction, is the fact that if you look at the traditional retirement savings vehicles, they are based on saving a percentage of one working individual's income. And the adequacy is calculated looking at that one individual's income as opposed to the family or the household income. So, absent joint and survivor, there is a real question as to, unless, say, both individuals in a couple are working full time and saving in an appropriate retirement savings vehicle, whether the amount that's saved is actually going to be enough for that entire household.
It's a great point. I think far too often when I've written about this subject or when I get questions from readers, there's almost an unbelievable disregard for the possibility that they're planning for the household and not and not themselves. So it's I don't know how it gets overlooked, but one of the interesting sentences in your report, David, is that that you suggest that retirees will be best served by income choices that are not limited to just the same approaches and products that were tried in the past. I find that interesting because it seems to suggest that what was used in the past will not work in the future. And though we've had a significant number of new products introduced, whether it's health savings accounts or reverse mortgages or QLACs, for instance, that there's still more to be done, perhaps, in terms of coming up with solutions that that will work for a large number of people.
I think that's absolutely the case. Yes. For one thing, we have technology today that enables us to develop products and solutions that would have been absolutely unthinkable even 10 years ago. And I think it's going to be important for the industry to take advantage of that and create new products for there. The other question that comes up is that we have seen resistance to a variety of existing products. I mean, obviously, the annuity is one of them. The fastest way to get a client to stop listening is to use the word annuity at this point, regardless of the fact that they might actually want the kind of features that are offered through an annuity. So one of the things that we are looking at is increasingly doing the research to find out what the individuals want, what is cost effective, and things along that line. I think that past products are fine, but past products don't really meet the needs of a very rapidly changing workforce and a very rapidly changing society.
Mm. So when you think about the products that are needed, I also think about the role of the advisor and the need for, I think, a new approach on the part of advisors, new training, new education, new ways of thinking, maybe even new laws that allow advisors to accommodate all the products and investments and insurance that they might need to build a good retirement income plan for their clients.
Absolutely. I mean, this is going to be a very active environment that's going to require an awful lot of work to keep up. And among other things, one of the questions that we're going to have to deal with is the role of the robo advisor and how that fits into the picture, and how you approach individual different clients of, say, different ages and income levels. We know that one reason that some people don't approach an advisor is that regardless of the amount of retirement savings that they have, they still think that they're going to be looked down upon, and that the advisor is going to be secretly thinking, oh, why didn't you do this, that, and the other? And you certainly don't have as much as you should have at such and such a time. And it
Right.
may well be that certain of these people are best served by something like uh, uh, a chat through a computer as opposed to in person. But I think this is a very, very fluid situation, and it's going to require a great deal of flexibility by existing advisors and the newer ones that come online.
Mm. It also strikes me that robo advisors, in some way, allow advisors to add value in other ways other than performance or generating income. Right, the computer, the AI can do that while the advisor works on other things, whether it might be maximizing Social Security or helping clients decide what kind of Medicare to get or what kind of assisted living facility or whether to buy long-term care insurance. Right, there's so many other things that go into advice that the robo
Absolutely.
can do. Mm.
Absolutely. And then the other part of it, which I think the advisor is going to need to do, is to basically check the solution for the robo advisor to make sure that what's coming out of it is appropriate and uh, actually meets the needs of the client as opposed to the needs of the program that's being used to develop that information.
Mm. So before we move on to another topic, you mentioned it earlier. I just wanted to have you touch on it a little bit more, which is this problem that we have in the States is not unique to us. Other countries around the world are grappling with this very same situation, and other countries, Australia, the UK, New Zealand, among others, are fast at work trying to come up with solutions, and in some cases, perhaps a bit ahead of us in terms of what they're doing. Do you want to just touch on some of that for a bit?
Absolutely. This is a really interesting situation where we can actually learn from the positives of these various international experiences, and also learn from some of the negatives. We see, for instance, in the UK, they have implemented a universal automatic enrollment mechanism whereby all workers who have incomes of roughly above £10,000, that's about $13,000, have are automatically enrolled into a retirement savings plan and make contributions to that. We see in Australia there's a mandatory savings plan. In New Zealand there's an automatic enrollment plan. Ireland is in the process of implementing one that'll come online in the next 2 or 3 years. But we also see internationally that while the initial focus has been on coverage and participation, the question of leakage is incredibly serious. Uh, Australia has now created a mechanism that consolidates different retirement savings accounts into one. The UK desperately needs that. If you look at the largest provider, the National Employment Savings Trust, which is the default provider, you find that fully a third of the people who have accounts with them are not saving anymore because, for the most part, they have moved to another employer that offers a different plan. And these amounts can be lost or forgotten about or eaten up with fees. We see in Australia, they're having a serious discussion now, and in the UK, of what is the best way to convert the retirement savings into income. Australia has got some very innovative ideas. And in the UK, they basically opened it up. They ended their mandatory annuitization several years ago. And what we're finding is that a small but a significant proportion of individuals are either being scammed out of their money or they're putting it into less than optimal solutions. So there's a tremendous amount of work that's going on, and it's definitely worth our while to at least keep track and see, well, what mistakes we can avoid, and also what lessons we can learn.
Mm. So before we move on to the next topic, state-sponsored retirement plans, one more question about, as you're talking, I'm thinking in some ways the solution to what plagues us, in a way, almost already existed in with respect to defined benefit plans, and maybe the execution of the DB plan was incorrect, and maybe a universal DB plan, perhaps, right, a portable DB plan. Um, uh, might have been the solution instead of the 401k plan.
Oh, yeah. I mean, when it comes right down to it, especially in the United States, our retirement income system is the product of an accident and anecdotes and circumstances. There never really has been a serious plan that says, here's what we want to accomplish. Here are the different ways of achieving that. Now let's get on the path and get this done. Instead, we've seen what was basically a tax loophole become our primary savings mechanism, and a variety of other things like that. So, yes, a traditional DB definitely was better. The DB was a victim of a variety of circumstances, ranging from low returns on investments, longer longevity, things along that line. If we had done some actual planning and the like, we might have been able to fix the system and come up with something that's much better. But now we have to deal with the reality that we have.
Right, and obviously we've had commissions that looked at major policy changes, right? I think the Bipartisan Policy Commission not too long ago looked at this and came up with some wonderful proposals, but I think many of them still sit on the shelf. I
Most of
think,
them.
right, if I'm not mistaken.
Yeah, and I mean, during the Carter administration, we actually had a commission that looked in this, and that's sitting on a few dusty shelves now, but nothing was ever done with it.
Hmm. So, among other things, we should probably start putting that talk into action at some point, as opposed to having another commission. Speaking of solutions, you've have been an AARP, I believe, has looked at the state-sponsored plans that are now in effect. I believe in Oregon, Illinois. I'm probably missing a couple. You can name the others.
California.
Um, California, right? So, and many states are looking at putting them in place as we speak. Do you want to talk a little bit about the sort of the status of these state sponsored plans, and then the ability of advisors to be helpful in getting them adopted and used?
Absolutely, and taking advantage of them, which, frankly, there is a real business advantage that comes out of these state-sponsored plans. What has happened here in so far, we have 3 states that are up and running, and we have another 3 or 4 that are going to be starting within the next couple of years. Is that this implements something called the automatic IRA, which Mark Every and I developed in 2006, which is essentially an automatically enrolled payroll deduction IRA for in specific lower income savers, because most of or a significant proportion of the people who don't have access to a retirement plan are moderate income as opposed to, say, higher income or something along that line. These plans are being required. In other words, in those three states and others, employers, sometimes of a certain size or above, and in other cases, for instance, in the case of Oregon, all employers are being required to either offer this state-sponsored retirement savings plan or to create a private sector plan instead. And we are finding that employers like this, and even more important, employees like this. And while the growth of these plans has been fairly small, we're seeing average contributions of about 5%. We're seeing the participation rates at somewhere in the neighborhood of 75% of those who are auto enrolled. And we are seeing that this is actually working as a simple, very simple mechanism to help people to build some sort of retirement security going forward. And this could be in the form, a long-term form of, say, annuitized retirement income or phased withdrawal retirement income, or it could be something simple like providing people with enough money that they can live on for a period of time and delay taking Social Security. Now, for an advisor, and I've talked to many advisors who have looked at these things and said, well, why are we doing this? This is a complete waste of time. And besides, it might compete with me.
Right.
And I think that they need to look at it in precisely the opposite way. Every salesperson I've ever talked to has told me that the second sale, the upsale, is easier to do than the initial one. And what we're seeing with the state facilitated retirement savings plans is that virtually all employers are being required to get started with this. And I know of at least a couple of fintech providers in various states who are basing their business model on going to these employers and frankly, picking and choosing the ones that they think would be the most profitable and saying, well, now that you've got the experience of payroll deduction, automatic enrollment, let me sell you something better that will make it even easier for you to attract the kind of employee that you want to get and keep. And I think this is a real opportunity for advisors to actually significantly increase their book of business at a much less much lower level of effort than they would have had before these plans existed.
So do you see examples of that anywhere in Oregon or California or Illinois that advisors are?
It's still very early, but I have taught, and for instance, both the Illinois plan has been in effect for about a year, the California plan for just a few months, Oregon for just a couple of years. But I have talked to several providers who say that they've actually been going into employers in advance of these plans coming into effect. And they actually have been making sales. And what they've been saying is, look, you're going to be required to offer this. Let me do something better that will make you even more of a hero to your employees at a significantly low cost. So yes, I am seeing some, but it's anecdotal evidence. These plans are still too new to have any empirical evidence at this point.
Well, I think speaking, for the Investments in Wealth Institute, where there are some 12,000 members, many of whom are serving employer plans or would like to be in that marketplace, this could be a great opportunity for them. So we should make sure that they take full advantage of it. So,
absolutely, and if eventually this is going to happen on a national scale. So even if advisors are in states where these plans don't exist at this point, they can still use this as a talking point to go into businesses and get them interested.
Right. Well, anything else our listeners need to know about the state-sponsored plans? That would
I
be
think
helpful.
the key one is that this meets an opportunity. And one of the advantages of these state sponsored plans is that they show that the model works and that this model can be also applied to private sector products. But the second one is that we don't need to scrap the whole system, as some policy people have advised, that instead that with an appropriate amount of work, we can actually make this system work for everyone. It's just going to be a matter of being flexible and being creative.
Okay. So we've covered a lot of ground, David. I'd like to give you one more opportunity to sort of closing thoughts about state of retirement security in this country, in the world, or what's left to do that people really need to focus on as we think about the challenges ahead.
Well, I think that there are several, and thank you for that. There are several things that we need to think about. That one of them is to start to break out of the silo thinking, where we just look at one particular aspect of the problem. But realistically, as we continue to focus on coverage and participation and automatic mechanisms to help people save in an appropriate investment and save the appropriate amount, we also need desperately to deal with the question of portability, so that rather than an individual having at retirement 5 or 7 different retirement accounts, they can easily and hopefully automatically combine those into one pot that is much easier to administer and much easier to use. And then, second, we need to continue to do work as the Secure Act starts on being able to convert that retirement savings into actually an appropriate income level. Because the goal of this, all of this, is to make sure that people retire in a comfortable manner and that they actually have the kind of future life that they've been dreaming of.
Mm. Well, that sounds like a good place to conclude, I think. I really want to thank you for coming on the Exceptional Advisor podcast, and I'd look forward to having you come back on in a few months or so and talk about either a new paper that you've written or a new law that's gone into effect.
I'd love to. That would be fun. Thanks for having me.
Thank you for listening to our podcast. My guest today was David John, a non-resident senior fellow in economic studies at the Brookings Institution and a senior strategic policy advisor at the AARP Public Policy Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit our website at investmentsandwealth.org to learn more about our certifications, conferences, online learning, and continuing education programs.